Good morning, everyone. Welcome to our monthly CGBN webinar. This is where we bring commercial practitioners from all over the world. We talk about hot topics in real estate, have a Q&A after the presentation, and then allow everyone to introduce themselves and perhaps advertise one need or want. This session is recorded. We put it on the NICAR site as well as the NICAR YouTube station. We ask that everyone mute and presumably have their screens off during the presentation, but you can turn them back on once the presentation is done during the Q&A. We do stop recording once we have the networking session, but we do give time for everyone to do that. Feel free to put your information in the chat. We save the chat, and then that can be shared later if you didn't have a chance to save it. So we appreciate everyone here. If you ever have someone that you think that should present here, we're always all ears. We like to hear from individuals all over the world. We've had presenters from Japan, South Africa, Latin America, all over the world, and talking about sometimes their country or even topics like ESG, whatever really makes sense for this webinar. So I would like to introduce a few people here. We have Dimitro, who is now the current chair for CGBN, that's the Commercial Global Business Network, it's a multi-association endeavor. So we always welcome all associations to participate. So if you want to do a little wave, Dimitro, say hello. Also, we have a former chair here, Ahmed Badat, who is a wealth of knowledge and super great at connecting everyone. And Ahmed, if you want to briefly introduce yourself and let us know what will be coming up next month, that would be great.
Thank you for the introduction, Teresa. Next month, this topic has not been covered through the real estate in the real estate industry in the past or presently. It is going to be on an analysis of a country risk assessment. So this is what U.S. corporations do when they're thinking of investing abroad. So we have an expert coming on, a young guy, he's a dynamic young person. And so this presentation was going to be done at that time. But I just want to mention two folks there. Antonio, he's always there with us, man. We got to go to Portugal one of these days. And Adrian Arriaga, he's one of our pioneers in the global field at NAR, and I'm glad to see him here. He's also one of our top CCIM commercial practitioners. So, Adrian, good to see you here. Thank you.
Thank you so much. I appreciate the invitation. I'm excited that you guys got your stuff together. Not too many organizations do, to be able to do networking, which is the key in doing business globally. Thank you for the invite.
Thank you.
Yeah, especially in commercial real estate. And for those of you who are going to MIPIM, we will be at the U.S. Pavilion at MIPIM. Some of us from here, as well as NICAR and other associations. So hopefully we'll see some of you at MIPIM. And like I said, we always encourage different avenues for networking. Some of us are through the CCIM or exchange meetings, etc. And this one is really great because it allows us to network beyond places like MIPIM and Expo Real on a regular basis through a webinar. And like I said, we have it recorded. And so the information is still out there, even if you can't make it, and you can connect with others later. So I would like to introduce our presenter, Rhea. She's been on multiple presentations this month, and I'm going to give a fair warning, she's not feeling great, but she is still super happy to present the information talking about gateway cities. She is the CoStar Senior Director of Market Analytics in Chicago. And of course, CoStar has data across the US as well as the world. So she could give us some information across some of the various gateway cities. So without further ado, I would like to introduce Rhea Stephen, and she can go through a wealth of knowledge for us. Thank you very much.
Oh, sure. Thanks so much, Teresa. Well, let's get started. So, I'm starting here with a screen on, with a PowerPoint, a slide on, and some of these slides you're going to see that there's going to be a Chicago presence, but I'm going to kind of see Chicago as like our starting point a lot of times. It's just because it's my reference point. But this is just kind of a slide showing about, industrial space, which is what Chicago is a real strong driver for our market because it's 25% of our economy. But it really has other bleed overs into retail, into multifamily, and tangentially into office. So the union strike, the strikes that were on the West Coast, which, with bringing in goods there, really kind of not only before the strikes happened, but even, not only during, but before. And then now we're looking at that strikes are going to be happening possibly on the East Coast. And this is just kind of a slide just showing you that, the middle coast, right? The third coast, the Midwest is really kind of already has their, contracts already signed on for the next 6 years. So that's going to be less of a stressor. And this is really a kicking off point for, we just kind of see the ripple effect of the dominance of the Midwest market. And, this is I did a presentation at the Federal Reserve in December, and this is just kind of a screenshot at one of those slides. And it's really interesting because if you see some data, it shows that, American savings have gone up. Because of the what's that word? The cushioning that happened during the pandemic with the disbursement of funds. But what we're seeing here in this slide is showing that it's going back to people's savings have been since depleted. We're seeing credit card risk going up. So even though we're seeing on a trajectory, you could see a line saying, oh, wow, savings are going up. If you really take it down, it's like the rich are getting richer and the poor are back where they were. So this is something that we need to think about for consumer spending. So with going a little fast. All right, guys. So this is a slide. I don't know. Can you guys see this, or can you read it?
Yes.
Okay, there we go. I'm going to get this off the screen. There we go. All right. So, let me get this thing off too. All right, there we go. All right, so net absorption is the difference between move-ins and move-outs. So if you have positive absorption, that means more people have moved into units than were actually moved out of. So what we're kind of seeing in here is that the A's and B's are cannibalizing C's, the inelastic demand class. So when we're seeing negative absorption for the 1 and 2 star properties, that's kind of showing you that there could be some headwinds to issues going forward. There we go. All right. So, here's our base case forecast for the national level. What we're seeing is, yes, we had a little bit of a negative absorption in, 1 quarter of 2023 on a national basis. That's that tiny little yellow dot. So like even 2020 outperformed it. In Chicago, we did have positive absorption for 2020, but barely. And it was because Q1 and Q4 were strong, which is, just letting you know. But if you're really looking at this, we're seeing net deliveries are outpacing absorption. So that means we have more product than people moving in, which is going to cause vacancy to rise. So we're seeing that kind of like it's going to be coming to a head, through most of 2024, and then should be starting to be coming down during 2025. And the real reason for that is because under construction levels, kind of coinciding with interest rates rising, have really plummeted. So we're not seeing the starts that we used to see, that we had been seeing over the last, 4 or 5 years. And so that is kind of coming to an end. So as you're seeing, looking at this, you can see there's going to be some balance here where, absorption is actually matching and then starting to outpace deliveries. And so we can probably get back to our equilibrium. And just looking at that, equilibrium for the market, I think it's pretty fair to say that it's around, it's about 6.75, just a little over 7%. So we are going to be in a heightened vacancy period for a while for the nation. When we're looking at net absorption as a share of inventory, these colors are just kind of, through these slides, you're going to see the highlight of the Midwest is going to be in green. But, just looking at this from a national basis, we're seeing that, we still have some strong Sun Belt markets. We do have the Austin, the Orlando kind of coming in there, but we're also seeing more of those major markets kind of coming back into absorption figures. And we're going to be seeing a lot more of like the Midwest coming in. But, when we think of multifamily as a driver, it's a direct relationship can be with retail. And so, retail is going to be following this wave of, the big migration that has happened in the Southeast and the Southwest. So that's, we're looking at, rent growth of the major markets. The national index, if you really look at this, the blue line is representing under construction as a percentage of its inventory. That you can really see how it's really not very balanced, right? There's just a slew of much more inventory than there is rent growth. And, to this point, so as much as we saw positive absorption with Austin, we are seeing negative year-over-year rent growth there, Atlanta and Phoenix, some of these areas that are really just kind of getting affected by too much trophy product coming onto the market. Chicago has that kind of pretty color, where we're actually seeing that it is reversed. We have rent growth is surpassing inventory growth or, under construction growth. And, Orange County is like that too. But then Washington, D.C. is its own little character, which is seeing actually the highest rent growth, but also seeing some pretty strong under construction markers. I'm kind of familiar with DC. And I know that they do have a lot of limitations on growth. And there have been issues with really drastic undersupply. And I would say that undersupply for multifamily, we do have a housing crisis in this country. And, some are faring better than others. But, when people can't afford rent, having a 5-star with a pool and a dog track really doesn't satisfy the needs for affordable housing. So when we look at when I actually decided to add Midwest markets into there, kind of expand my lens, just really seeing how Midwest rent growth has really, come to the fore, central part of the country. And we're still seeing, but it's not necessarily because we don't have this exponential growth of under construction, right? Because you can look at markets like, actually the ones that are big ones, I suppose, like Kansas City, Missouri, we're seeing a big increase in under construction, but rent growth is actually pretty decent. And all of these are, so like I said, we have 11 that are actually beating the national average. So rent growth by market, once again, if you're really kind of looking at, the right side of the screen, you're seeing negative 5%, Orlando 3%. Some could say that these are problems because of the luxury market. It's rents back to where they were, because for a while there, we were seeing some markets recording over 20%. Or close to 20% year-over-year rent growth, which is really not sustainable. And then once again, we're kind of seeing that predominance of the Midwest on the left side of the screen. And I don't know if you guys want me to linger on these slides, if they're very, very interesting to you. But what I've seen kind of in the past is seeing major markets kind of coming back in, but this predominance of the Midwest really kind of struck my fancy. So, under construction by star rating, and I think this was really fascinating because we're really not seeing, used to seeing under construction, seeing the 3-star property come online. And, you know, I have to say that Chicago has been, because like I said, that's my reference point. You know, we've been in this territory for a while because we don't need pools. We don't need maybe somebody needs, but we see a lot more of NOAA here, which is naturally occurring affordable housing. We see a lot more 6 flats, 3 flats, the missing middle housing. I don't know if you all are familiar with that concept, but basically if you have a 3 flat with 1 vacancy, you know, that's 33% vacancy. And so you're likely to want to lower your rents because you don't want to have that much of a vacancy. It's the bigger units that can actually absorb some of that pain of vacancy. But we're seeing a lot more 3-star coming online, which is a pretty good trend, I think. But just to let you know, and I'm sure you all, if you are in this business, you know, it's the cost of build, right? It's not only that you're trying to get, you know, permits pulled, which in Chicago is difficult. Same with Orange County, which has a lot of reason why that market has been really tight and showing a strong market growth, is because there's just not a lot of land to build on there. With us, it's more just, politics, NIMBYism, which is not my friend. I'm not a big fan of NIMBYism, not in my backyard. People who don't want to have development near their homes, even though there are so many other, you know, societal benefits that come from that. Voters, but residents vote, corporations don't. And so the cost of land can be cost prohibitive. And so you really are kind of forced to build luxury because you have to charge a higher rent. But it's great to see that we're seeing, you know, more incentives coming online from different municipalities, encouraging more affordable housing or NOAA, naturally occurring affordable housing concepts. So this is just kind of showing you, like, on a national basis. Once again, I can't find this slide that's just strictly that's national. They're kind of based in Chicago, but Chicago is a representative of the Midwest. We're seeing here the last 2, it's been about 15 months where we're seeing Chicago's rent growth outpacing the nation. Chicago's rent growth is normally about, as you can even tell by looking at this graph, it's about 2%. So we are well above our, our national average. The last time that Chicago beat it was in 2010, after, you know, what happened in 2009. So we kind of got a wind of this, right? Because Chicago didn't lose as much. And so then when they bounced back, they came back stronger. And then but that was only, like, 2 years that we were beating the nation, and that's kind of what's happening now. The projection is that this should be going on for a while, though, because of the oversupply that's going on in the nation. And so this chart is just this is about Chicago, but it really is a kind of I would imagine that softly we could say that this is a national trend. And the reason why is because, where we're really seeing rents nationally going down is with the 4 and 5 star, the Class A, the trophy properties. That's where we're seeing rents going down, where Chicago really has a supply issue. And so that really pushes up our Class B rents. Okay, so I am going to go into this. All right, so retail trade by category. I actually, did I delete the other slide? Yeah, I did. So when we're really seeing on a national basis, we are seeing that tenants are, where we're seeing the most strength is in food service, experiential, and discount retailers. That is really where we're seeing it. Now, I thought this slide was particularly interesting, and it was really primarily because of this electronics line I found to be fascinating. And what that really is actually a reference to on a national scale is about inventory surplus that, we had. What happened was during the pandemic, we didn't have enough goods coming in because of the bottlenecks, constraints in supply coming into the ports. And so then when they finally came in, it was like this flood of inventory that now we have too much inventory. And so the big retailers like Target, Walmart, and I'm drawing a blank on another one. But they, are just like, they're just starting, you could see it in a trend line that they're starting to normalize. Actually, they definitely are normalizing at the level that they had 2019 of having the right amount of inventory, in the back office, so to speak. So I thought this was really an interesting slide because just showing you the correlation between how people spend their money and how space is occupied. So here we're seeing that retail sales are becoming much more efficient. We're seeing less business closures, and we're seeing more profits that are happening on a per square foot basis. So if we actually put this line on the left, the filled in graph on the left, and put it into a square foot basis, it really matches up, pretty, what's the word I'm looking for? It matches up pretty seamlessly. So seeing that the sales per square foot. So retailers announcing the largest openings and closing. This is also a national slide. The yellow dots represent, like, they're actually on both sides of the screen. And that's really because, like, Foot Locker is, vacating malls and going into freestanding or strip centers. And Bye Bye Baby was purchased. They went into bankruptcy, lost all the losses. But now they were bought out. They had acquired through IP, the Dream on Me. So they are starting to actually take over some of those Bed Bath and Beyond stores and reopening that were closed over the last 12 months. So I just took the screenshot last night, looking at national retail supply and demand. And if we're looking at this vacancy rate, because I'm a big believer, if you ever watch me, it's like I'm a broken record on equilibrium and structural vacancy. So it's like that whole planned vacancy, right? You know you're going to have it. So what are your reserves? And it depends on the market or the type. Sorry about that. It looks like that, it's like when you have a structural vacancy, certain markets, are used to having a higher level of that. Chicago is one of them as a major market. But if you just, taking a quickie glancey at this from 2014 to 2023, I think you could say that the average vacancy rate is probably about 5%. And if not, actually, honestly, more than that. And now we can see that we're below that, almost like just above a 4.1%. So this is just record low vacancy levels. And there are some, how do I say this? It's really probably the strongest asset class that we have in the United States is retail. Which is kind of funny because usually it goes up and down, but retailers have so much more data than they used to have on, what their needs are. So when they know they need to come into a place, they hightail it, do all this research, and they don't leave. And that's kind of what we're seeing: less move outs than move ins. I mean, less move outs and more move ins. So when this is a list that I made for Chicago. This is something that we're seeing nationally. So I don't think it's really that much of I'm really just being so myopic on this. But I'm highlighting the points of what we're seeing discount retailers. And that's the problem under the hood. These are the retailers that are not paying top dollar for per square foot. They really prefer to, they sometimes are located in, industrial parks, like a dumping place. So they want to pay $7 a square foot. They don't want to pay 27. So they're going into taking over a vacant Lord and Taylor or a Bed Bath and Beyond. And they are saying, fine, we'll give you $12 a square foot, but they are tenants of necessity. So that's kind of showing you that the cracks in the foundation a little bit of the retail market. So once again, also a national trend that we're seeing is that people just want to be outside. So we're seeing the neighborhood centers in general, retail doing better. Mall absorption is still positive. but marginally positive. I did pull some national data looking here. Let's see for absorption. Yeah, so actually on a national level, we do see some negative absorption that's going on actually in every single one of them across the board. But at the end of the day, we are still seeing, positive trends that are going, for retail. So net absorption as a share of inventory. Yeah, we still see that. We see that Midwest. We're seeing how the Midwest is kind of establishing some dominance recently, but we still have these high growth markets, right? We've got Austin. Oops, sorry about that. Austin's. I'm trying to see if I can click on this to actually see what the number is, but it's not letting me. So I think Austin is let's just say it's over 3%, just looking at this, visually. But we're still seeing that kind of those warmer markets coming on. But then on the other side, we've got some negative opportunities here, Orange County, which has really strong rent growth, right? Seattle is seeing some negative movements of 500,000 square feet negatively absorbed. And the reason why I have green dots on these two was that, at least they're not overbuilt. And that was kind of my comment on those two, because a lot of times when we see net absorption going negative, and then I also know that those markets are overdeveloped. And so then it's just pain on top of pain. So we're looking at rents, we're going to see those warmer climates kind of coming up to the fore. And then, the Midwestern markets also coming on here. And now I'm going to try to pick up my pace a little bit because I got 8 minutes left. Oh, goody, I'm at industrial already. Okay, so we're looking at top net deliveries. It's really a lot of times we're going to see this. This is really not surprising to see the Midwest on here, although I don't see it often on the top leaderboard because sometimes these markets are just smaller. And so these are just done in raw numbers, but seeing, that they're coming up here actually on the leaderboard and, flat out square and millions of square feet is pretty impressive. Chicago, it takes turns with Dallas, Houston, and Phoenix is kind of being, those are the top 4 markets that kind of take, rotate a little bit. But if you really actually look at the infrastructure and the train lines, you could kind of understand, why these are top areas. It's not only because we have a lot of growth that are going on in the Southwest, but it's also about having access to distribution. So under construction, we are seeing, once again, the Phoenix, Dallas, and Houston, they're on there. We're seeing New York kind of coming up on the market. And so these are there are some areas that are going to be some, with the East Coast, if they go under strike, that could be some problems that are happening with the industrial space market. So here I just, did a screenshot yesterday of the national industrial fundamentals. And the same thing that we saw going on with multifamily is we see positive absorption, but deliveries are certainly outpacing absorption. So that's where we're seeing vacancy rising. This is really an issue because we still have a lot of under construction still going on, as we can see kind of looking forward here. We're still seeing those lines, yes, they are definitely dramatically dropping, but at the height of 140 million square feet, going down to 110 million, that's not really all that hopeful, truthfully. And what's really scary is this slide about the industrial market. And, Chicago really actually doesn't suffer from this as much, but I haven't really crunched the numbers yet. So newly delivered properties, they are exhibiting positive absorption, right? So are properties that are less than 1 year old, but older than 1 year old, they are having negative absorption. So that's really an issue. And it's these build to suits. So, we had this influx, just unheard of influx of speculative design, speculative product that came online that actually was getting filled, and now it's really stopped. And there are certain markets where this is not a problem. And for example, we have a submarket called, it's the Joliet area. And I'm looking at, yes, we have an influx of product coming online, but it has a 4% vacancy rate. It's really hard, to be concerned about that. Or we have O'Hare near the airport. That actually is having negative absorption, but it's 4% vacancy rate. Really hard to be concerned about that. But then there are plenty of other markets that are really lagging that have 14% vacancy and they still have product coming online. So they are, I would say that unfortunately, there's a lot more of the Kenosha's, as I would call it, which are kind of the outskirts of the Chicago market that are really struggling, or sometimes when they're actually really near a very strong market, like Elgin has a high vacancy rate, high delivery, and it's pretty close to O'Hare, and it was kind of relying on a spillover, but it's just not seeing the demand, and these speculative spaces aren't getting filled. This is just kind of a slide that I made showing how the Midwest, for the first time is really dominating by being below the national average for industrial space vacancies. And it's that, at least for Chicago, it's like keeping that supply a little more tight. So new industrial completions mostly lead to more move-ins. So if we're looking like an example of Phoenix, Arizona, that has let's see. So new and expected completions are about 17% of the market. That is huge. But then look at it. It's also growing by over 3% of its absorption. So 3% of its market is actually getting reabsorbed, right? So when you look at this chart, there's generally a trend that the more construction you have, or new and expected completions that you have, the higher your absorption is. Chicago is just kind of unique in that it's actually pretty strong absorption, but just really doesn't have these completion competition, supply side competition. But then when we look at the bottom four, so the bottom four don't really have high amounts of construction. So you can see why their absorption issues are as they do have absorption issues. And then you have some places like Inland Empire, right? That was really hit by the by the strikes happening on the West Coast, and they still have more product underway. So Inland Empire is really in a very stressful situation. Lost really when you're looking at it, all the four bottom stragglers, all of them are port markets. So. And, New York is probably going to get hit going forward because of if there are strikes on the East Coast. I mean, even the anticipation, is. Now, so once again, we're seeing the net absorption very similar to the delivery. And if we're looking at leaders and tenant retention, most of the markets actually are Midwest, and then two of which are in Chicago, the Joliet area, which I did mention, and then I-88 West. And it's interesting. So exclusive flex. Okay. So, I-88 West doesn't really have it doesn't have the density that's happening in Joliet. So it's kind of spilling out, but it still has good highway access, which is really going to be important for industrial growth. Once again, like kind of looking at where we're seeing rent growth happening. We're seeing the Midwest really having some dominance on the left side. And then on the right side, we could see that, Toledo, the green, the red dot is just my way of saying, oh, this isn't great because they're being overbuilt. But then these blue, the teals are saying, you know what, I'm okay with this because at least it's not as overdeveloped. And these are still above average rent growth or just about, average rent growth. It's just that industrials has been just so hot as of late. So office. Okay. So office, this is where I do get a little bit myopic and just really seeing kind of Chicago's situation. But, if I was going to say anything about a national storyline, it would be if you have a strong CBD or central business district, you are going to be suffering. So it is, the tertiary markets that have, okay, that have the quaint downtowns, their markets are not defined by having office space. And, I have this quote from Jane Jacobs because she really talks, in her book on the death and life of the great American cities. It's really, really amazing foreshadowing of what kind of happened after 2020. And she predicted that. She's like, you can't just have a market, or an area where just people are eating. I mean, you're feeding somebody lunch 5 days a week. You need to feed them lunch and dinner, and you need to do it 7 days a week. So, what I'm seeing as a projection is I'm seeing a projection for, at least for Chicago, to have, we're going to have a lot of pain over the next year or two, just a lot. But I really do think that the Great Basis Reset, because we are just seeing so many properties falling and going into foreclosure or just to extreme distress. 50 cents on the dollar is pretty much common that we're seeing in Chicago. And at those prices, then the new owner can really substantially lower rents. And really, honestly, it's what a market needs. A market needs a diversity of property, classes. Because if you have a bunch of office space that's all, trophy, guess what? In 10 years, those are all going to be dated, right? So you need to have a variety of price points. And this is just kind of showing you, how there's a disconnect between absorption. And this is Chicago, but I just saw a slide earlier today from a national call. It's the same story, which is like they're disconnected absorption and actually move in. And now that we have negative, office jobs are declining. Well, that certainly is not helping absorption, in Chicago. And one of the things that we really want to say, is just to stop the storyline of flight to quality, because it just really isn't true. We are seeing negative absorption across all subtypes. And so, this is the national office supply. The struggle continues, right? So we had almost, nationally almost 60 million square feet. And we are projecting that to be increased by, at least 40%, if not, actually more than 50% increase of negative absorption. So this is really going to continue. We really just need to pivot and repurpose and find the highest and best use for these properties, because this is a change. This is a structural change of demand for office space because of COVID. I shouldn't say because of COVID. It was probably a trend that was already occurring, but it was accelerated during COVID. So, this is a slide that, and I could probably, I can't help it. I have to keep going. But Teresa, just cut me off if you want to cut me off. But what we're seeing here is really what we saw in Chicago is that we saw a slew of inventory coming online, and I know we needed it. We needed more product, but we didn't need 13 million square feet. So Chicago just really got hit. But guess what? Chicago is stopping right now, but on a national level, we are still seeing deliveries coming online. I mean, it's just, it's sort of like you're married to the spouse who just doesn't listen to you, and you just keep doing it. And so there's going to have to be a divorce, because I just don't understand how this could actually just keep going forward. So something really just drastic, has to happen. Net absorption, I think this is just kind of interesting that you can even have negative absorption and be on the leader side, which is pretty scary. So, just kind of hitting home my point, if we're looking at leasing versus leasing sizes between 2019 and 2023, we can see that, 1 through 3 stars actually see an increase of leasing, but 4 and 5 stars are seeing a decline. And then the change in the average lease sizes, just putting it in a different context. This is not a flight to quality if you're going to have literally over 40% decline from 2019 in your space size. And then this was kind of interesting because the 1 and 2 stars, like who builds 1 and 2 stars? Well, believe it or not, they do get built because it's like a medical office building. Just you drive up, you go in, you see your doctor and you leave. Not really high quality stuff. On a national basis, it's only 7 million square feet, representing 2% of the inventory. But guess what? It's what's seeing the most of the demand. So it's really not about new construction. I mean, about star quality. It's really about a construction date. And then if we're going to just kind of like looking at capital, sales volumes, when I'm looking at the data, it looks like, wow, a lot of 3 million deals are getting done, more than usual. It's like, no, it's more that they're floating to the top. Because, if we do index it to 2021 Q4, we're seeing that it only went down by 50%, whereas 50 million or greater sales went down by 80%. And so that's really what's having these float to the top. This is very Chicago centric, and I'm running out of time. This was, I thought was kind of Chicago centric. All right, let's look at our cap rates. This kind of goes under my whole argument about just the curve line of the retail is just, having less stress in it. With the green line, it doesn't have as much ups and downs, and we're actually seeing those cap rates compressing. I am seeing, anecdotally that hotel is doing well, but I don't really follow hotel at all. And I have a peer who does that. She exclusively follows hotel. So rent growth by property type, once again, just seeing, kind of more of that stability with retail, big influx with multifamily, which makes sense, right? Because with 1-year leases, you can go, wow, we can really raise our rents. And then you have to say, whoa, we have to really go into deacceleration mode. So that's what we're seeing with that. Industrial is still kind of the favorite child right now, especially when it comes to rent growth and a lot of investment. But like I said, there's really some headwinds coming online for that. And these are just, I always include a bibliography because the articles that I cite, I mostly cite myself though. Just got to be honest. I think I'm pretty awesome. So, but that's it. And if you have any questions, just let me know.
Thank you. If you can unshare your slides. I certainly have a lot of questions. And then if anyone else has questions, please do raise your hand. So I have about 10. So I don't want to be all the questions. I am interested in.
How do I stop sharing? Did I do that?
It's all right. If it doesn't work, it's okay. Well,
oh no, it's because I moved my little screeny screen.
Kathy could always revoke your status. One, I guess I'm interested in, probably the biggest question is what you found to be super surprising when you're looking at overall market outlook. Because, you typically do focus on Chicago, where were the biggest gaps or the biggest differences from prior years? What was something that really stood out and was surprising to you?
I think that it's nothing really surprises me. It's like I liked the way the data. I think my favorite. Okay, the biggest surprise was really the net was how poorly older properties are doing nationally, because we do have that here in Chicago, but not really. Because our market is just so much tighter. So on a national basis, seeing how much of a problem that was. But even if you have a nucleus that you're hyper focused on, I'm always looking at myself in context to the peers and to the rest of the market. So I knew all of these trends, that were happening. It sometimes is surprising because sometimes I look at the data and I'm just like, what is going on here? So the surprises when I don't usually see surprises on a national scale. I will see surprises on a local scale when we don't follow the trend.
Okay. I saw that you have cap rates for various asset class. I am curious in terms of acquisition, what trends you're seeing, how much people are buying based on, okay, it's got to be higher than a certain cap rate, or they are looking for value add opportunities.
So, with multifamily, there last year, we saw a big trend for opportunities to upgrade. So we saw a lot of 3-star properties going across the table, because the new owner saw opportunities to fix the driveways and fix, not the parking lots, add some washer dryer units, put in some new countertops, some value add opportunities. What we're seeing now is more investors really leaning into the sure thing, that they already are completely occupied and completely or virtually occupied, and that they are already, amenitized. So that I'm seeing a lot of those coming across the line for multifamily. And then then office, it's really seeing a lot of distressed sales. And I do think that Chicago is leading that charge of distressed sales in a good way. And I really do mean that as a good way. Like it's really hard to tell some owner like, oh, yay, thank goodness you're so highly leveraged, you have to turn in your keys, but that's really what's happening. And that's a good thing because we need to reinvent the market. Like, in the Chicago market, we have some zombie properties in the suburbs, just these big campuses that are vacant, and they've been vacant for decades. And it's just like they're just so hopeful that somebody else is going to come in. It's like, no, nobody's coming in. One. And two, they were already paid for. So they used as a what's the word I'm looking for? As a
Land bank.
Yeah, as a depreciation, like they just wrote it off, their losses. So it just got so bad or they finally found buyers, but in the downtown Chicago, you've got zombie buildings that you would never know they're zombies because it's people are just walking around, but there are some zombie buildings down there that something needs to happen. So.
And, I always go, when I go to MIPOM or Expo Rail internationally, I'm a Chicago cheerleader because we can tout things like we have the largest fresh body of water. We're a logistics hub. But speaking to that logistics hub, I noticed, obviously, that you had Dallas as twice as much in the industrial space. So what are the competitive advantages that Dallas has over Chicago that they would have that much extra industrial?
So, I think some of that can be misleading because, and by the way, Chicago's is data centers. They are the second in the nation for data centers. We are number 3, but word on the street is that we may be passing them. But Dallas does have that. So, they also can use solar power, to keep their, because keeping properties cool is important for industrial space. And so they can actually use, harness the sun. That's really big in Phoenix. And then, it's just that.
Well, that's the irony, right? Using the sun to cool it off.
No, the sun to power.
I know. It's just ironic.
I know it is. It is. I know. So, but that's one of the advantages that Chicago has is for cooling is that you actually send water up to the roof to cool it in the winter. So that's a strategy that we have, but we also see more people are finally getting smart that we need solar in Chicago. I mean, I talk to college educated people and they don't understand that we just have just as much sun as other places. It's just that it's cold, so you still have the sun, like use your head. That's all I gotta say about that. But, and also just, industrial, when, the national director goes over industrial space, he frequently ties directly into retail demand. And so that the loss of one of the slides that I usually cover, and I think I took it out just because I only had 30 minutes, is, looking at home sales going down. Well, home sales going down, then you're not filling those homes up with goods, right? And so, but you do have strong population growth in the Sun Belt. And so that strong population growth does translate into retail, which does translate into industrial space. So that's the long-winded answer to that question.
So, and then, I mean, I can ask specific questions about space, and I'm going to ask something about retail and then portfolio investment. If anyone else has a question, please raise your hand. We have a few more minutes of Q&A. So I'm going to come back. This question on investing in portfolio. If you were to take into account capital markets and commercial real estate, what would your pie chart look like if you had, $100 and how you would invest in capital markets versus the various asset classes in commercial real estate today? So we're going to come back to that because I'll give you a couple seconds to think about that.
I'm going to give you a quick answer. I can't
Okay.
give investment advice.
Oh, I know. This is not investment advice.
Well, it kind of is. It kind of is because say where would I invest? So I can't. I'm not touching that.
Okay.
I just will tell you. I see trends of being, some things being less volatile than others, but.
And then with the retail slide, you were showing, demand of retail. So what I was wondering is how closely the demand for retail products aligns with the commercial real estate. So for example, electronics was second. Does that mean that that's the second occupier of retail space?
No,
so
no, yes.
Trying to figure out the alignment.
Right. So that was just talking about just in pure dollars.
Mm-hmm.
And that was also a slide that was just about December. So it's taking it out of context because normally I have the slide that says, experiential and discounters and things like that. I normally have that one, but I took it out just for time reasons because I knew I would talk about it. But that electronics one was to just kind of show you that it was more about distribution, just saying that companies are actually letting go there was a lot of sales. And Teresa, you saw my presentation at Inland, like that was kind of that whole thing that I saw during the checkout line. They would have a 6-foot flat screen TV as my what is that called, like your point of purchase? What's that, spontaneous purchase, right? So they're really trying to get rid of the big stuff because they have too much of it. So that was really what that slide was about. And I'm sorry if that was misleading.
Well, it would be. I would be curious to see how that lines up of what is the retail demand of product, not just for December, but in general, what is the demand versus the occupancy of retail space?
So home goods are really struggling. And that's why that electronics actually kind of stood out to me. It was like, wait, that's a home good, So, but I think it had to do with clearing out inventory. But generally speaking, we are seeing, home goods stores, Home Depot, Lowe's, they are not doing well, because you don't need that much stuff. People aren't in fix-it mode. We did that when we were in, what is this, the stay-in-place orders, shelter-in-place orders, right? We're like, well, I can't sell my house, so I may as well fix it up. Well, guess what? You don't need to fix it up again 3 years later. So.
So speaking of different data, and we didn't talk about it here, is 1031s, because this is always a discussion politically as well as, where the investment potential is. And so how closely does CoStar track 1031s? And,
we do. We tracked 1031s. I've never seen a slide on it, but sometimes when I'm, looking in the data, they will show up. They'll kind of like, I'll do one of these, like, whoa, that's a lot. I'm not seeing that much. I think the 1031s have pretty much have been worked out. Not saying that there aren't any left. Word on the street is that 2024 is going to be a big year because we're seeing, funds that have to deploy cash, their dry powder. And there's just so many great opportunities. I mean, people were waiting for the bottom to happen. And the bottom is here for, at least for office, for sure.
And for our international crowd, 1031 is a vehicle that we can use to tax defer purchases of commercial real estate. So it was always a form in the U.S. to keep capital in the U.S. So it'll be interesting to see what happens politically. I have my own opinions on that, which we could talk about separately, but nevertheless, it's another avenue to watch in what's happening with acquisitions. So if no one else has any questions, I didn't see anyone. Oh, Demetra has a question. Go ahead.
Question. Do you have any information on input on medical office buildings and the cap rates they're going at Chicago versus nationally?
I did write a piece about that about 3 or 4 months ago, about medical office, and I am seeing medical office definitely coming up more in line. Like as a recession safe place to put money. Office used to be a proof of recession. Help protect you from recession because they have 10-year leases. Right. But now people are paying much more attention to termination clauses.
Right.
Because we see some big movement in that direction in Chicago. But to get up and pick up your toys and leave in medical office is pretty expensive. In all honesty, the problem with medical office, we do track it, but a lot of times the brokers will put in there that it's a property is medical office when it isn't. It just clearly isn't. So to write that piece took me hours of just taking out those, those monikers. Yeah. So it was kind of difficult because it was like, yeah, it's medical office. It's like, dude, you don't have water in every room, right? You don't have a bunch of little offices. It's not medical office. So, that's the unfortunate thing is that we do let brokers determine, sometimes. And that's the problem that we have with lab space too, so because there's a lab for, because it's a medical office, well, no, that's not lab space. Lab space is, about experiments and clean rooms and things like that. So.
Okay. Thank you.
All right. We are going to call this quits here shortly. Thank you very much, Rhea, for a very comprehensive view of what's going on in the U.S. We hopefully will be able to share these slides in the near future. This recording will be on the NICAR webpage or this commercial CGBN Commercial Global Business Network page, as well as our NICAR CGBN YouTube page. So you can watch that recording there. We appreciate in the future if you have suggestions for presenters, especially those that are outside the US. We try to start the beginning of the year. We're a little bit late, but we try to start the beginning of the year kind of going with a US market overview, and then thereafter bouncing around the globe as we can fit it into our schedule. So I hope to see everyone at MIPIM. And after this recording ends, everyone is welcome to stay on to say hello, where you're from, and perhaps advertise one need or want. So thank you for listening and have a wonderful day. Ciao for now.